Welcome to EP10. How are you, Simon?
I'm doing well, Melissa. How are you?
Fantastic.
Are you fantastic?
I am fantastic.
Tell me why you're fantastic.
Because we have some special guests here today to talk
Oh,
about.
Everybody's seen me last week and the week before. We talk about. The very, very special guest. Yes, we do.
Yes. I'm looking forward to today's show where we're going to discuss infinite banking, which is something that I don't know a whole lot about. So
perfect. Most of our guests are fairly new by comparison to those who are seasoned individuals on the topic. And folks, for all you jumping in, this show is really kind of we're trying to answer a question. And that's okay. You're crypto rich. Now what? What do you do with your profits? Where are you gonna stick it? Because I personally had a moment in my life where I did pretty good in crypto, and I had great ideas with no plan. So of course it kind of failed at that point. But still, I thought I had good places to stick my profits. Right, to keep earning some money and income producing assets, those types of things. And I didn't have a good vehicle. So here it is, round number 3. The bull run has commenced, and I have recently, I would say probably in the past couple of years, came across this topic, which is the infinite banking concept. This concept was discovered / I would say created by Nelson Nash. For those of you out there wanting to know where this originated from, it originated from Nelson Nash. But in truth, the concept has been around for a couple hundred years more that I'm aware of. So this sounded like Manny, holding up the book right there. There it is. There you go, right there. Becoming Your Own Banker by Nelson Nash. Great book. You can get it on Amazon if you're a page turner. I'd recommend getting it on Amazon and on Audible so you can read and follow along, because in the book there's actual illustrations that I'm sure JV, who's with us tonight, he can touch on some of those in our discussion. So a good book to have in your collection. Thank you, Manny, for that. Manny, how long have you had that book? That looks fairly new. There's like only one dent in it.
It is pretty new. Actually, can you hear me?
Yeah, we can hear you.
I don't know. I'm thinking like June of last year.
Perfect.
Even though I have known about the infinite banking concept for like years and years and years, but I never really studied it because I even was on their mailing lists. So I would just go through that. But then, of course, you got cryptos, you got all these different things that you think you're gonna do, and you end up doing some,
None of it,
or one,
yeah, or some, yeah, exactly.
And so
exactly.
this one was on the wayside way back. So that's where it started, and I finally, I guess I just started having a little bit of, I don't know, whatever it was, and I said, hey, I need to do this, because of course you think about protecting your assets and all these different things, having to do with protection of what you earn, like you were saying. And so from there, I just started slowly, and it took me like 3-4 months, 5 months to finally actually go and get the like you do
The policy.
a physical, yeah.
Oh yeah. Now you're committed. You're going to go through the process now.
Yeah. So there's
right?
a lot of things to it, but yeah, that's about, that book's pretty neat. Yes.
Well, speaking of the physical, Elizabeth, welcome to the show. Welcome to the show. For all you crew fans out there, Mrs. the real captain of the Staple Crew is in the house tonight. So thank you for showing up, Elizabeth. But you yourself, you just recently had your physical done for the infinite banking concept, correct?
Yes, I did. And by the
Yes?
way, he calls me Admiral.
as he should,
And
my
that's not,
apologies
and that's not meant to be nice, I don't think.
yeah.
Oh.
Only when you're in big trouble, it's like, no, it's Admiral. That's it. That's order. You go handle it. Elizabeth, aside from some of the present company included, had you ever heard of the infinite banking concept at all in your lifetime? No, fairly brand new, right?
Nope.
Right on.
Not at all. Not at all.
What clicked for you when you started just kind of looking into it? What was just your this is the move moment? This is the thing that I need to be utilizing in my life.
The infinite philosophy, okay,
Mm-hmm.
and the females, I think Melissa maybe understands. I don't want to insult anybody out there by being gender specific, but the infinite, the security, I have a husband that loves, you may or may not know this from his show, but he loves the dreaming of the Lambos, not specifically a Lambo, more like a Porsche 911. But anyway, the dreamer of the Lambos, and he's a yacht captain, and he's big, right? It's big thinking. And I'm more like secure. What am I going to do when I'm a little old lady? I don't have a pension. I don't have nothing. I have nothing after 20 years. I've been a sole practitioner. So this is kind of felt like a safety net. It felt like something I could pull off. It felt like too, like I'm a worker on a hamster wheel, and it felt like it legitimized the fact that, number one, I like working sometimes, most of the time. But I thought, am I going to work until my friend, the lawyer, worked until he was 85 on the phone with a client and dropped dead? Like, is that what I'm planning? And the debt, always the debt, the load with debt. Like, no doubt I'm not airing my dirty laundry, but figure it out. I'm a lawyer, a student loan that it never, goes away, a mortgage that we just got signed up for, you buy something, it's just debt and debt and debt. And I went bankrupt when I first became a lawyer, because they send you a bunch of credit cards and you've had nothing for a long time, and you buy, and you buy a car and you buy this. And your job, you're a starting lawyer, they pay you peanuts to do, like you're the grunt man, right? And so I went in debt, I went bankrupt, I just started over. And then I said, well, I'll just pay cash for everything. And then when I read that book, it's like, that's the worst. Don't pay cash for anything. Like, so I have to tell you, a lot of different things clicked. I did what you told me to do. I read the book. I read it again. I listened to Vance's podcasts. I got I did the call. I did the exploratory call. I mean, I just did. I listened to his podcast again. And then I listened to I watched some, and then I'm a skeptic. So I was like,
absolutely
perfect. I looked on the whole life insurance, because I'm a lawyer. So it sucks. Everything's, be suspicious about everybody and everything. So, infinite banking concept is a scam. So I blazed through those, and there's just nothing of substance to go, oh, okay, it's a scam. Like when I buy something, I look to the 1 star. And if the 1 stars are legitimate for why not to buy it, I won't. But if the 1 stars are just trash, like they have no substance to them, I go, oh, okay, I'll go to the 5 star. And look. I don't know, nothing Dave Orman or Susie Orman or whoever Orman's saying it's a scam. And I'm like,
Ramsey and Orman's got it.
I can't quite figure out why it's a scam.
I think I might
that's good.
Oh, okay.
Ladies and gentlemen, JV from legacyvision.life. JV is a newly became an agent not too long ago for whole life insurance policies. Is that correct, Mr. JV?
Yes, I was digging into trust. I was setting up a family trust late the year before last, and stumbled across Nelson and went down this long rabbit hole. It's too good to be true. I had to dig. I run into the same thing Miss Elizabeth did. You can't get straight information. Everything's a little, you're just not sure. You run into Dave and those guys talking about, oh, it's a scam. Well, if it's properly designed, it is not a scam. It's exactly what Nelson says it is. And if you read the book 2, 3, 4 times, because you can't it has to be caught. This is a process that has to take you over, take your mind, and rearrange the way we've been thinking. Miss Elizabeth's right. The wheel, the slavery, this slave system that we're in. I watched my dad work all his life trying to raise 5 kids. He goes to retire, and then he passes away 6 months later. Basically, the same thing happened to my grandfather. So if you will learn about this and teach this to your family and create family banks. In other words, when you go out and you spend cash for something, you're not just spending cash. You're spending all the interest that cash could have made you for the rest of your life. And this is the kind of money that gets passed down to your kids, your grandkids. You can create legacies beyond, especially if you use a trust. Now these are contracts, and if I get long-winded, you guys just let me know, because I'm fired up about this.
Don't worry, brother. Hey, it's good to be fired up. It's good to be fired up, man.
If I can use this to change the world, that's what I'm going to do. Well, I learned about infinite banking, that I got in touch with infinitebanking.org and talked to Mr. David out there, because I wanted to attend the think tank. I found out Nelson was from Birmingham. Well, I've been in Alabama all my life. So I was upset about that this guy was doing this. And see, it's not about the policy. It's a process. It's about how do you, pay yourself first, pay yourself back, and rotate that money. If you And everybody won't say, well, why would I pay myself back? It's my own money. Because capital has a cost. When you go down and you spend $5 at Starbucks, that's probably $100 at least compounded for the rest of your life. That's money that your family will never get back. When you let a dollar loose, it's gone for good. So this here creates a way to recycle. You know, if you're going to buy a car and you get that money back and you got the car. And people can't wrap their head around that. So if you take a win in a lump sum like crypto, and if you made a mistake and you got some coins that you probably shouldn't have been messing with anyway, well, it's okay, because if you don't pay the loan back, they're going to take it out of your death benefit. Now, this is life insurance. There is a death benefit that comes with it. But to me, I look at that as icing on the cake. I don't care. I mean, I do care about the death benefit. The older I get, the more I care. But I really only want it for banking purposes. It's not a bank. It's to take over the banking function of your life.
Right.
I'm going to let somebody else talk, man. You going to get me done.
So, JV, man, what was, but just real quick, what was your aha moment, or this is it? This is.
Well, I watched a lot of Nelson. Nelson had this way of explaining it in a way that I just couldn't pick up from the other videos. And then I started digging, and I had to order the book. I ordered 3 or 4 books. I passed them out to family. By the way, if you give that book to somebody, they won't read it.
Yeah.
But if they'll spend $20 on Amazon, they'll read the thing.
Yeah, they will. Yeah, they will.
But you almost have to read it 2 or 3 times for it to click. You know, interest, taxes, those steal your wealth. Uncle Sugar has got us doing exactly what he wants us to do. We put our money in a 401k. We lock ourselves away from it for our entire lives. Meanwhile, our daughter's getting married. Life is going on. We need a car, whatever. But we can't get to that money, not without penalties. And we're doing nothing but growing taxes for them. One day, when you get that money, you pay tax on that.
That's right.
This here is
you do.
This is tax free. If it is designed right, it is tax free.
That's right.
And if you'll pay yourself back, who's getting the interest? You almost have to think like the bank.
Yes.
When people that work at the bank, when they take a loan, do they have to pay it back? Yeah, they pay it back. Do they pay it back with interest? Yeah, they pay it back with interest. So you'll hear people in these videos saying, man, you can't take a loan. I mean, you're not really paying yourself back with interest. You're paying that to the insurance company. Yes, you are borrowing from the insurance company's general fund because your money is in there compounded. You know, if we talk about the penny doubling every day for 30 days, I don't know if you guys have heard.
Oh, hold on. I'm going to show a calculator. We're going to go into that in here just a little bit, JV, because I want people to really see that. So I'm going to pause you on the calculator. So don't get everybody excited on $1 million dreams.
When Simon shows that, just think of what happens if one day you have to go in there and steal the money. Now, that could be 401k fees that they're charging you to manage your account for you. That could be anything, but the idea is non-interrupted compounding. That's what we got to have.
Okay, perfect. So I'm hearing that sounds like mental security. Okay, and I do mean mental security. For me, I see two instant benefits from this process. Okay. One is the natural death benefit, right? I die one day, I graduate, I go upstairs to the man upstairs, I do all that, wife gets a check, a healthy check to, deal with life after I'm gone. Me, that feels good, right? What is epically awesome is while I'm still here, I can utilize this process to finance every single endeavor that I want to take part in. Now, most of us here are into crypto at some level, and I'll tell you what, if I could go borrow $20,000 without no credit check, no, what are you using it for? Hey, you got to put up all this extra stuff for collateral. How many kids you got? We're going to need 3 of them. None of those extra things, right? I could take that 20,000, go buy my cryptos, XRP, Quant, HBAR, maybe a few other ones, maybe a little bit of Divvy. Anyways, I could buy those. Bull run goes up. I profit, take my original investment back, throw it back to my bank with interest because I'm a good debtor. And now I have cash in my hand that I could spend out in the world. Now, instinctively, that's what I thought of doing first, right? But I didn't understand the whole giving away your dollars and now you've lost all that compounding interest. Now I'm more like, no. It goes back and I'm going to start another one, but we'll get into the science of that. But that's what it was for me, because at the same time, JV, that you were you did not stop in my ear with this. And before you, there was another individual I think they joined us on Spaces, NFT Solutions. Is he on Spaces, Melissa?
He is on Spaces. Yep.
Oh, good. Yeah. NFT Solutions. He and I did an interview back in 2021. And he talked about the infinite banking concept to me. He told me about Ness and Nash, and dang it, if I didn't listen to him then, but he was the one that planted the seed in my head. JV was the one, he was the intense water miracle grow on the exponential growth in this idea. And here we are today. But NFT Solutions, brother, do you have a chance to come on the mic? And what's up, Melissa?
Can I interject?
Interject.
So, first of all, I want to welcome everyone that is watching the show right now. We have several people in here. We have Brent, we have Lisa A, Crypto Professor's in here, Cody's back, Mr. Man is here. Welcome, Mr. Man. We have I Am What I Am visiting us on X Spaces, and of course, NFT Solutions is here watching and listening as well. I kind of want to circle back for a second, because I
Sure.
am you guys are all much more educated in this than myself, and I am dipping a toe, so to speak.
That's right. Well, you should dip your toe in this. This isn't
and I was very excited about this show because there's so many of us out there that we might come into a quote unquote windfall someday, one of these days. That's our hope anyway, right? That our hypothetical assets that we're holding will one day give us a little bit of barrels, a little fruit, right? And then what do we do with
Right.
this fruit that we've got?
So we don't lose it.
Right. And so
yeah.
this whole thing, and what Elizabeth said earlier regarding the infinite part of it, that is very intriguing to me also. And being your own bank and paying the interest to yourself. Well, you're paying it to the insurance company, but it's my understanding that you're part of that. You're putting your money in, so you want them to succeed, right? It makes sense, because otherwise you're going to be paying that interest, considerably higher interest, to a bank or another lender of sorts, right?
But actually, Melissa, that interest is all paid to you. Technically, when you start paying that back, that's all to you.
That's what I want to touch on. So what I would like to do is, if Legacy could please, in a nutshell, just for those like myself who don't really know, and you're trying to get people interested in this whole infinite banking concept, in a nutshell, what is it? What is this? You buy a life insurance policy that you can borrow against. I mean, that's the long and short of it, but I know there's way more to it. So I just wondered, could he just give us a, you know, a short,
Sure.
what is it?
Well, I like to call it the process, that it has nothing to do with insurance. Now, you'll think that that's crazy, but the reason why he chose whole life is because it's guaranteed by contract. As long as you don't get involved in these IULs and other things that, the whole idea is to take risk out. If you're still in the market, if you're in 401ks and all that, that's investing. There's a difference between saving and investing. Now, like my policy's 5%. That's what it would cost me to take a loan if I wanted to take a loan against it. But do I want to take a loan? You bet, because my capital is in there compounding. I do not want to interrupt that. If I take 1 penny, 1 cent out of that, that affects the compounded rate over time. Go ahead, Simon.
JB, may I interject there? So when you say you don't want to interrupt the compounding, if someone was saving that same amount of money, okay, that's in there, okay, separately, they don't have, they're not involved with that process. They're just saving money on the side, and they've saved up 20,000, but they have to spend 10 on a car. How long? Right. How much time are they out of for that 10,000? How much loss of time are they out of for that 20,000? With no benefit, right? That's kind of
when you're talking about
interrupted and not interrupted.
Right. Well, when you're talking about compounding, I mean, that's the main reason why we use the whole life designed a certain way. And you were right, Melissa. It's with mutual companies that pay dividends. They pay dividends to the shareholder, or not the shareholders, but the policy holder. You don't want to get involved in any insurance company that, and I don't know, Mr. I don't know the people that are against whole life. I can see why they are, but the reason why we want it is that contract. Miss Elizabeth probably knows a lot about contracts. I mean, this whole world is created off of contracts. We sign a contract when we get our driver's license saying, yes, you can pull me over and molest me on the side of the road if you need to, if you think I did something wrong. So the contract is the key to it. And with it being a private company, and I hope I'm answering this, but Simon, you're right. You don't have to have an insurance policy to do this. You could just use an account. I mean, your piggy bank. And maybe that's the way you should start. So you learn how to pay. People have a rough time paying themselves back. They have a rough time paying themselves first.
They do.
If you can't get those principles in your head to where you can manage, money and debt, then you may not be ready for a policy. But yeah, I mean, that compounded growth, that's what you want. What better piggy bank can you have other than one that's growing at 6% on average? 4% roughly for the guaranteed side. The dividends usually 2%. They may go up because interest rates are going up right now. They just have a lag. They've been paying these dividends for 150 years. You'll go check. You'll go pick it. Yes, ma'am.
Yeah, go ahead, Melissa.
So the between the 4 and the 6%, that's on the money that you've put in, that you're going to continuously earn that compounded interest. The dividends themselves are those paid off of the company's success? Then that's a separate. Yes. The dividends are separate.
Yes.
Than that. And then the other thing that I understood while I was listening is that even if you took a loan, and I want you to correct me if I'm wrong, even if I were to take a loan, say I have $100,000 in there, and I took a loan out for $50,000, I'm still earning the 4 to 6% compounded interest on the full 100,000 while I've took a loan. Is that correct?
Okay, I don't want to get too technical. We want to
Okay.
sort of keep it general, but they are different companies, and some of the companies have direct recognition and non-direct recognition to where they recognize that you've taken a loan or they haven't recognized that you've taken a loan. For instance, if me and you have a policy with the same company and I take loans and I don't pay them back, and you take loans and you always pay yours back, is it fair to you when the dividends get paid out? That is a direct recognition because they are trying to take care of all the holders. Now, there's non-direct. The direct recognition where they notice that you've taken a loan, those are usually a flat rate loan amount, like mine's, 5%, whatever. But if it is non-direct, they don't recognize, those are an adjusted rate where the rate of interest could go up. So if you're a real estate investor, you've got a deal going on, or you're, you sold some property and you're using that money to pay back your loan. Well, if the interest goes up, then that could put you in a little spot. So I sort of like the direct recognition myself because it's a flat rate. So if I loan money, if I'm a bank, that means I loan money. I loan private money. If I loan money to someone for, 10%, I don't want my rate fluctuating too much if I'm working off a margin like that. I hope that makes sense.
So do you get a choice then when you go to take a loan, whether it's going to be direct or indirect with the company? Is that how that works? Then?
No, when the policy is set up at the beginning, they are direct companies, they are non-direct companies, and then there are companies that let you choose at the very beginning which one you want.
Okay. So that's kind of if you're gonna dip a toe into this, that is something that you should probably understand prior to
back up a little bit more to your question, Melissa.
Yeah.
You have, let's say there's 2 Melissas in the world right now. Twin sisters. Let's even go with that. Okay. Got twins. Yeah, I know. Hey, what's up here? I love you.
Hey.
Okay. One of you did the infinite banking process through the through the policy. Okay. $100,000 is over there, like you stated. All right. So you have $100,000 available to be borrowed against, collateralized. Okay. Your twin sister, you love her to death. She's a good sister. Maybe not the sharpest crayon in the box, but you still love her. She's got tenacity just like you, right? She saved $100,000 in a savings account, right? You both go buy a car. You collateralize $20,000 of your within the process of your policy, right? Okay. The insurance company cuts you a check. You go down there, you borrow it. She comes in like a baller and says, "Bam! That's all $1 bills. Have fun counting it. I'll wait." Right? So here's the problem is that you pay back the loan with interest to a company that is taking care of you and that's taking care of you this whole time. Secondly, your collateralized and uncollateralized $100,000, $20,000, and $80,000, it's still $100,000 that is still earning that compound interest. Correct, JV? In theory,
yes,
simple terms.
That is correct. That is
Okay.
correct. Some
Now,
of that would be considered direct, and some of it would be considered non-direct in that example.
In that example, correct. But the sister that just saved her money, she's now, if she's willing to do it, she has to pay back that $20,000. You're both paying it back, but you're gaining interest. She's not gaining nothing, right? Right. And over time, you're going to have a greater gain, and she's going to have a bigger loss just because of that. What I say?
The Staple Crew would like to know how he can get the blonde's phone number.
This first off, Mr. Crew, you're gonna have to address her as Admiral. Let's just start there. Then you'll see if you can get a private dinner later, but
I did want to
know.
bring in Mr. Man has a good comment here.
copy that.
This sounds like the perfect setup to mortgage lending. Take out a loan, earn interest on the full loan, and with the loan amount taken out, lend the amount for a higher rate. Arbitrage.
Yeah, brother.
Yes,
You
and
are.
there's a lot that do that.
Yeah, there's a lot that do that.
Except I think that you don't have the same protections. You don't have the tax protections. You don't have the privacy protections. Your money's exposed. All of the other ancillary benefits that come from the whole life insurance policy scheme. I hate to use the word scheme, but whatever.
So you're saying, so Mr. Man sounds like he's saying, hey, I got a policy I can lend out to as a mortgage lender. Mr. Man, make a comment down there if I'm picking up what you're putting down there. So you would use that to go fund somebody else's real estate deal, or you yourself could.
Oh, sorry, I misunderstood. Take a loan from yourself.
Yeah.
Right.
Yes.
Yeah, he gets it.
That would be that would be the move. And in fact, I'm Melissa, thank you for highlighting Mr. Mann's question there, because personally for me, I've heard of just a sidestep of me expressing my instant value that I saw in this process. I don't know if anybody knows who Pace Morby is, but he has what's called the Gator method. Basically, if I was an up-and-comer real estate investor, right, my first thing would be to learn how to get a house under contract from a motivated buyer. Then I sell that contract to a wholesaler and I make a couple grand on top. Okay. But when you get a house under contract, and everybody knows this part that has a house, you have to come up with that earnest money, right? You got to say, I'm committed. Once you do that, it's under contract, right? So in Pace Morby's method, you find somebody else that has that money and make it a joint venture. So they invest, the $3,000 earnest money, and you give them half the profit on the deal that when you go to sell it to the wholesaler. So let's say the earnest money was $300,000. The wholesaler said, I'll pay 2% above sticker. So the house is $300,000. That's what is that, 12? Is that right? Maybe I'm doing that wrong. 6. 3 is 1, 6. So $6,000 plus the earnest money back. So $6,000 plus $3,000 plus the $3,000 is $9,000. The investment individual Pace Mortgage process, they get their earnest money back plus half of the $6,000. So they're good. The person that got the contract together, they got their $3,000 for not having to put no money up, and they're good. Where this comes into play, you yourself could instantly be that person. You could instantly be that person and enter into a short-term contract, being the short-term lender for that person to get the contract and then sell the contract to another wholesaler. That actually happens all the time, right? But what this does is your loan gets paid, your loan, because you're borrowing from your I'm sorry, JB, you're borrowing from your policy, the collateral side, the cash value side of the process, right? You're borrowing from that and you're giving it to so-and-so for you to make money. They do that, they do the deal, the money comes back to you plus interest because you're gonna be good and give that your bank interest. It goes right back in that pile. It's a done deal. And you got $3,000 on top. And what are you going to do with that? Well, I would stick it right back in the policy if I was able to, which kind of gets us into another part of this process, which is the difference between a life insurance policy or whole life insurance policy and investing. According to, say, the IRS, right? There's a line there. And JV, could you kind of touch on the kind of what the difference is between that with the IRS's view?
Well, back in the day, there were rich people that were dumping a lot of money into insurance policies. Now, if you go really digging into the history, you'll find out that insurance is where people stored their wealth. But after the stock market come out and then all that started happening, they trained us to go a specific way. That's the whole point. But so they come up with a 7-pay rule. That's what it's called. But in other words, you can't just throw as much money as you want into a policy. You pick how much you want to pay a year, and that can be paid monthly or however you want to do it. But if you start trying to put more money in than that amount, the IRS calls that a MEC, a modified endowment contract, and then they start treating it like a 401k. So you got the same rules, 59 and a half. You get penalized, that kind of thing. So we don't want to do that. I mean, that's what I mean by properly designed. If it's designed correctly, it won't make. Now, there's ways to throw a lot more money, and we'll have like a term policy. I hate term. Actually, to be honest, I hate insurance. I've always hated insurance because I feel like it's a waste of money. If it's a medical insurance, they're going to do the cheapest thing they can, put you on the table and roll you out. If your house burns down, you'll be lucky to get enough to put 2 befores back up. But when I ran across this, the way it's sort of set up, there's a base and a PUA. There's 2 sides to it. The base is what drives the policy. The PUA, you could just call that the cash side if you want to. That's an easy way. But all that money is compounded. But at some point, the PUA pretty much has to drop off so you won't make in the future. It could be 30, 40.
I have that illustration. Sorry, may I, JV? May I?
Yeah, sure.
I have that illustration with kind of a breakdown of what you're kind of touching on, where you're talking about contributing X amount of dollars per year, and some's going to the death benefit side, and some's going to the cash value side, and you're talking about dropping off. Would this be a good time to show the folks on the stream
sure.
that? Okay, then
because if you look at that contract carefully, it'll show you the MEC amount. It'll show you what you can put in it per year. So the goal is to stay right as close to the MEC as you can get without going over. That's really what the goal is.
Okay.
Is there a
Let's
way
see
to
if
make
I
that
can-
bigger or no?
I'm totally going to do that right now. And then I will try to zoom in here. Just give me a moment. Oh, whoops. I don't want to do that. Let's do it over here. Is that better? How's that look?
That's
looks
much-
Everybody in the
great.
crowd can see that? Okay, perfect. Then let me get rid of this Doom of 5. I can't get rid of it. Right there. All right. There we go.
If
So-
you'll notice here, you're putting in $24,000 for the first 5 years, and that is the base plus the PUA, what we call paid up additions.
So the cash
paid up
side, right?
Yeah, that's what we call the cash side. And the reason why
Okay.
we do it like that is so you'll have cash available on the first year. If you look to your far right under the cash value column, second column there's cash there. Well, if this here was just a regular whole life like Dave fusses about, there would be no cash in that column, and there would be no cash for probably 15 years or very little, when over here you paid in all this money, but there's hardly anything in your cash. Now, if you'll notice carefully, it looks like, oh, well, you mean I'm paying 24,000 and I only get a 16, but look at the next year. It's almost like, especially if you're into real estate, you understand houses, or you understand creating a business. This here's like a guaranteed,
Liquidity.
it costs some. Yeah, I mean, it costs money to get it started. Like if you were going to create a business, but you're guaranteed to make a profit the next year, and every year after that, you're guaranteed. If you look like at age 51. You're putting
So right here, age 51.
Yeah,
Yep.
you're putting $7,200 in, and your cash value grew from 104 to 112. And every year after that, it gets better and better. But that's the key. And now somewhere on this document, I think it's down a little bit to the left or to the right, it'll have a MEC limit, and you'll see how, you're
Down
just
here.
right inside. Keep going, keep rolling.
I think the Met limit's back at the top.
Okay.
Yeah.
Oh,
the,
yeah, this
the
is
Met.
the last
Yeah.
page. Yeah.
Yeah. This is the last page. Sorry, folks. I know I'm kind of going a little fast here because this right here, I want you guys to remember 24,000, 1 penny. 24,000, 1 penny. Because I remember the MEC I was talking about earlier. Right here. MEC, short for modified endowment contract. And here is the amount that or if I was doing this policy, not that I am at this time, that's the amount that I cannot go over. Correct?
Right.
Otherwise, either the IRS is going to say, dude, you're doing a 401k. You owe us some money.
Per year. Per year.
Per
But if you
year.
have a
Yeah,
good
per year.
agent, you can, like, if you run into some extra money, you can call your agent and say, hey, what kind of room do I have? Can I squeeze anything? But the whole idea is when it gets to the point where you're getting, income or capital, and your policy's full, your loans are paid up, then that's when you create your second bank, another policy
So,
on
okay,
your
so let me,
grandkids or children.
Is that MEC limit per policy or per person?
No, it's per policy per year.
So
per
you could have more than one, and each contract is the MEC is 24,000 for in this example. Could you have two at 24,000 to not go over?
You could have two separate policies at 24,000 each.
Okay.
yes.
Each
Yes.
one of them. See, you don't. The insurance doesn't pick what your payment. Like in this example, we have 24,000 a year, but it's the individual that decides how much they want. I mean, do you want to put $200 in a month? What would that be? A couple $1,000 a year. Can you finance a car? Can you? I mean, it really depends on what you're going to use it for. If you want to eventually get to the point where you're financing everything you own, everything that you plan to ever buy, then it needs to. Eventually, Nelson put it like, eventually you would want your income to match these policies, but you can't start like that.
Right.
So, JV,
I'm missing a lot. I'm missing a lot on. Yeah, I mean, one thing I want to say is, you want to research this, dig into it, make sure you understand it. I love talking about it, but I just, it can be a little bit. It's a different way of thinking about things. So I just wanted to, mention. You want to read the book 2 or 3 times at least. And Nelson puts it in there in a very simple way. You can understand the problem of taxes, interest. 34.5 cents of every dollar goes to interest for the average American family, but yet they want us to try to save 10%, maybe in a 401k where they're going to tax it at the end. If you can still just a 34.5%, you outdo any kind of savings that you were attempting to do.
right.
I'm sorry.
It's almost sounding like if you could get yourself eventually to the point where as you're making money, you're adding to these contracts to where then you could end up borrowing against it and using that to create other income generating.
Absolutely.
Yes, exactly.
Yeah, absolutely.
Like in the beginning, for someone who doesn't have a lot of money like myself, coming up with $24,000 a year, like at a chunk, that's going to be a chunk But as you pay down your debt, and then any money that you've been paying towards debt with interest and everything to everybody else, that money could then be going into a contract like this. You're already used to paying that. So then you're really paying yourself first, right? Am I
Right.
understanding the
Well,
concept?
and not only that, what is one of the better
Yes.
investments that, the way I see it, paying off a debt that you have and turning around and sending that same money back to yourself. To me, that's a great investment, I think, because you're building wealth. Now, could you do it faster if you just sent extra payments to your debt? Sure, you could. But this way, you are building something that's going to be compounding for the rest of your days. So it's just the way that you think about it. And that's why he called it infinite. Miss Elizabeth was right. When she says infinite, he talked about imagination. Whatever you can conjure up is in your mind. That's what you can use this for. And the more successful people are the ones that have the biggest imagination. I know that sounds crazy.
But Jared, can I ask you, I think that in listening to some of these podcasts and books, I heard, for instance, Vance talk about setting up a policy for his grandson just to buy a new bicycle. Like, the policies don't have to be that big. And I also wonder,
That's
I'm
true.
not clear on this, that you can just start a policy by create the policy. You just have to pay the policy premium by the end of the year. So you don't need you can do a $5,000 policy, divide by 12, and you have that policy. Now, you don't have the same, like if I can put $15,000 down tomorrow, I have access to that money in a couple of weeks or something like that. That you don't have that, and you're a little behind, but you're also saving and you're paying yourself first. You're buying yourself that policy for next year. You'll have it. And it's kind of like you buy it today and you pay them, you make payments, I think. But
yes. I mean, that is correct. And I love you bringing up a small child, because children can comprehend this once you teach. Here's your little bank, son. Oh, you want an Xbox? Well, this is how you take the money. This is our bank, and you have to pay it back. They can catch on it quicker than us adults, and I've been speaking the whole time from an adult point of view. But if you imagine a family trust where you have trustees, they're all members of your family. All the death benefit is paid into a trust if anything goes wrong. And anyone that needs to fund a new business, a house, a marriage, something important that the trustees decide. I mean, that's the way the Rockefellers did it. If you go digging to find out exactly how they did it, if anybody passes, all the policy loans that were taken out gets replenished again, because someone has passed away. And they just keep doing it generation after generation. That's the problem. They want us to start over every generation. If you can comprehend what we're trying to, if you don't see that there's a problem, then, you'll just do what you've been doing. But if you can ever catch on that there is a problem, Nelson used to say, if you know what the problem is, you'll know what to do. Well, once you start figuring out what the banks and Uncle Sugar are doing to us, once you just think about it. You don't have to really do anything. Just think about it in your mind, and think about every time you give somebody $1, that's money that your family, I hate to say it like this, but you're stealing from your future generation. Once you understand and can see the big picture, you're stealing from future generations. And that's what hit me the hardest when I was studying. Once I figured out, hey, I can't let another dollar leave. I have had millions go through my hand. I'm 55 years old. I've seen millions come through my hands and go out the door. Businesses, whatever, if I would have just captured that You know, if it's just $2 million, I mean, that's 120,000 a year that I'll be being paid in salary every year without even touching my principal if it were to compound at just the 6% rate. So
Mhm.
it's just the way you view, but you know,
But it's never, you know, pay yourself first, never use your principal.
Yeah.
right. That's what you're doing. And see, when we make these premium payments, we can call them payments if we want to, but they're deposits into our bank. Has anybody ever made too many deposits into your bank? You know,
No.
that's
Can't make enough.
once you,
Withdrawals, maybe. Withdrawals,
one,
maybe.
right, right. Once you realize that this is your money and you're always going to get it back, or your family is going to get it, and you can use it as you move along through life with everything that you can think of in your mind infinitely, it starts becoming bigger and bigger in your own mind. I know that sounds crazy, but
You know,
it's a crazy
JV,
world.
you know, when you talk about using it, right? When your family can use that money, right? My slightly brainwashed mind goes to the old ways, spend money, right? What we're talking about here is leveraging your money, right? When JB and Elizabeth talking about your principal, right? Your principal, you put money in to something, even if you put it under the mattress, that's principal. The
Well, can I
trick
try to
is,
make a,
yeah.
I'm sorry, Simon, I don't mean to
No,
cut
no,
you
no.
off.
Go ahead. Go ahead. Jump on it, man.
I want to
Preach,
sort
brother.
of make
Preach.
just a short example.
Okay, go ahead.
You know, if you draw a horizontal line, and
Oh,
we'll
wait, I
call that
got
the
you.
zero line.
Hold on a second. Wait 1 second. I got this right here. Hold on. Just let me. I'm close.
I just wanted to say, if Cody, if you do have a question, you want to type it up in there. We'll be sure we'll get to your question for you.
Yeah, let's after this illustration, let's take some of those questions. Absolutely, and more. But let me add this to the stage. Okay, let me pick out what color you want, JV.
Just black would be fine, brother.
Okay, here we go. Horizontal, right?
Yes, sir. I guess that'll work. Is that as good as you could do, sir?
Hey,
Okay.
flat Earth people would be all about that line right there. They'd be
Yes,
happy with that.
yes, they would. Well, let's call that the zero line. And every time, you know, the thing that hit me, Nelson said, you finance everything you buy. He kept repeating that, and I couldn't understand that. You know, well, if I go pay cash, am I financing everything? But yes, when you realize what you're losing. So off this line, most people, if they're going to buy a car, they borrow the money. So we'll go down from zero, say, you know, 20,000 for a car, whatever, and then they slowly pay it back over time, paying interest until they get back to zero.
So like
By
this,
then, and yeah, that'll
right? This is
yeah,
each
something like
line is you paid a little bit back, you paid a little bit back.
right
Whoa, you
until you
paid off
get
your
back
car and you're back to zero.
right. And by that time, you need another car. I mean, we're talking about 5 or 6 years here. You know, by then, and most people just repeat it again. This is what I call the debtor. Now, the Dave Ramsey folks, they are the savers. They believe in saving up the money and paying cash for everything. Oh, well, I don't want to pay interest, or I don't want to make payments. Well, you know, if you make one payment of $20,000, that's still a payment. But above the zero line, if you say, oh, well, I'm going to save up over time, I'm going to save up until I get 20,000 bucks, and then I'm going to spend it all at one time to buy this car. Well, I'm still going back to zero. So whether you're a debtor or a saver, I mean, they are both, you're ending up in the same place. But with these policies, because they're compounded, imagine that zero line coming out and starting to curve up. And eventually it's almost going straight up, especially in the final years. When you borrow off of that line, if you'll pay it back, you'll have more money than you did before you started, and you still have the car. Now, when I say car, that could be a house, that could be, that could be anything. But once you see that and understand it, you're growing this pile of money that never, well, I hope you guys sort of see what I'm trying to show.
Definitely helps. That visual, it definitely helps me
So, like,
understand.
there's a
But this isn't a
Go ahead,
get
Jerry.
rich. One thing that I think that Dave Orman and Susie Orman, I don't know if they're married or whatever, but this is not get rich quick. This is tortoise versus
Hare.
they're trying to make people think this is hare. We're the
That's right.
tortoise. We're just keeping our money and cycling it back and cycling
That's
it
right.
back and using the same dollars. Meanwhile, the insurance company, who's not allowed 10-to-1 leverage like the banks, they have to
That's
have
right.
1-to-1. They have never failed. There's no examples of them failing because they have to have 1-to-1. They pay you interest on that money all day long that you put in there. It's a winning concept for them. Why is it winning for them? Because people lack discipline. And then he talks about something like the arrival syndrome or something like that, where people
Yeah.
have this windfall of cash. They get their cash policy. They go out and spend willy-nilly, and then they don't have the discipline or a system of returning the money back to the policies. And then the people say it doesn't work, or they don't have the discipline, or they don't have a steady job, or they complain about the man or whatever. It's just like, forget about all that. The bank is not your problem. Mr. Rockefeller is not your problem. Mr. So-and-so, the beast system is not your problem. You are the problem. Either put your mind to work on this, put your money to work, go to work, collect your pay, put it in the system, and get out of your slave mentality, which is not the slave mentality that's talked about on the conspiracy shows. I'm talking about your own slave mentality, where you spend all your money on stupid you know what, I'm being good, magazines, Starbucks, restaurants. Make your own food at home, eat good, make a cup of coffee for yourself, save your money, stop being a slave. No one's making you a slave except for you. And this is a system that you can do it. But the Rockefellers and the banksters, they rely on human beings being lazy and
Yes.
undisciplined.
Yes. And what you just said, I love that when you said the arrival syndrome. When I was trying to set up a bank account for my trust, I went to every bank in my local city. Oh, we've never done that before. I don't know how to set up an account for a trust. We've never done that. Well, you'll find the exact same thing when you talk to insurance agents. They know nothing about the infinite banking. It's not something, I didn't want to become an agent. I wanted to do infinite banking. I wanted to do it the right way. When I got my policy, I got it from a place in New York who they sort of threw on a little extra term that I didn't need. But I didn't know that at the time. And I wanted to do policies for my family. Like I said, we have family trust. I wanted to do them right. And one other thing that you mentioned was recycling or using the same dollars over and over. Me and Mr. Manny was talking about this earlier. He was talking about Black Wall Street. I think it was Tulsa back in the 1920s, where these few blocks, they would keep the money within these blocks. People would come in and bring cash, building businesses, but they would not spend outside. I think it was referenced Black Wall Street, but they became so wealthy inside these areas because they were recycling the same dollars. And it's hard to get your mind wrapped around it, but when you think of $100 bill going into a town, and it buys paint here, and then the paint owner might take it and buy something at the restaurant, and then The restaurant may take it and go, pay something on their utility bill or something. Anyway, that $100 moves around through the town and could easily end up in the same person's pocket when he leaves town. But what happened there? You're using the same money over and over again to create value. And that's hard to get your mind wrapped around. But when you create your own economy with one of these accounts where you're using the same dollars over and over, like you were talking about, Miss Elizabeth, that's like, not only is your account compounding, but if you buy debt and then you're paying that back, that's another form of compounding. So you're compounding on top of compound. That makes any sense.
Yeah.
Yeah.
It does.
Yeah. It's beautiful, but it's the mind job. Cody Garcia, what's the name of the book you're referencing? It is Becoming Your Own Banker by Nelson Nash. Manny has an image for you right there. Thank you, Manny. 5th edition. I don't see any. I don't. Go ahead, man. You had a comment, didn't you? Go ahead on that.
Yeah, a little comment. Even though I have studied this, for however long, and then of course just recently I started to really get into it. Once I got my policy, I was still like, okay, how does this work? How does this work? So I was on the phone with the agents, and I went with the agents that James Nethery, he studied under Nelson Nash. He's in Dallas. So I went with them because I said, well, they studied under him, and so that's how I made my decision. But my point was that even though I already had my policy, I was still trying to understand how all this works. And and I was still kind of, maybe you can help us on this legacy vision, that as you put more money in there and your mech starts growing, is there a point where you cannot put more money in and then you just get a policy? But what I was trying to, there was another thing that your policy just grew to like 200, 300, 400,000, 500,000. It just kept growing. Maybe I'm wrong, but I'm kind of like a rookie, but at the same time, I know enough to actually get into it. So I'm dipping my toe.
No, you're right. James is a good guy. He's part of the Nelson Nash Institute. That's infinitebanking.org. If you're trying to find someone, I'm in that authorized practitioner program, but it takes a year or so, and they monitor everything that we do to make sure that we set these policies up the way Nelson envisioned.
Yeah, and that's the thing that.
But he'll catch you.
They have to set them up correctly, or else they don't work properly.
That's right. Yes. And what you were saying about, James will let you know, and it's not just James, the insurance company. If you try to send them too much money in a particular year, the insurance companies will come back and say, hey, a lot of times they just send you the money back. Hey, if we do this, we're going to make the policy. They know that, and a lot of these know exactly what we're doing. There's only a handful of these companies that we want to work with. I mean, yeah, we want mutual, we want dividend paying, but we want the ones that know what we're doing. We are taking loans. We're financing everything in our lives. So they know what we're doing with these. We don't want a problem where we're trying to get a loan and we can't get a loan. This is not like going to the bank. You just, hey, send me 20,000, and they're like, hey, sign this paper. Do you want that wire, or you want us to mail you a check? You're not getting down on your hands and knees, begging them, filling out a bunch of paperwork for funds.
Right.
And that's the key difference right there.
One more thing. I had a policy that I bought 20 years ago, and it was a whole life, whatever it was, whole life. But then I was like, well, how come this policy hasn't expired? Because it was still active. And so, and I think after that started happening is when I started getting back into my infinite banking with Nelson Nash and all that. So I said, well, and then I was talking to the people, and they're like, well, you have, $2,000. The reason is because you had a cash value, and the policy is paying itself every month, $12, I think it was. And so as that happened, I said, well, and then of course I was learning about Nelson Nash. It's like, well, can I borrow some money? And they're like, yeah, well, how much can I borrow? And they're like, well, you can send you got like $2,400. I'm like, wow, okay. So since I knew about Nelson Nash, I'm like, okay, well, send me $2,000. So they sent me $2,000. And the policy's still in place. So now I'm actually on that policy that's 20 years old. I'm actually sending a little bit of money to pay that back. But now that I got so that's how I like said, wow, okay, this works. That was my experience, my moment. And and I said, okay, I need to do something with the real thing, with the infinite banking. So I that's when I started talking to the other people so they could, help me out. And like I said before, like even though I already was in it, after I got my policy, I was like still asking questions. But yes, it takes a lot of study. Read the book, Nelson Nash, Becoming Your Own Banker. So
yeah, there it is.
Yeah, that's what I wanted to say about that policy that I had, and I got a couple of grand, and I was like, wow, okay, and that's where it started.
Man, he's like, it does work. Oh my gosh, this is the real thing. And they didn't even ask me any questions.
Yeah,
Woo!
well, I have something else to say.
Cool. Go ahead, Manny, and then we'll go to Melissa.
We have
go ahead.
I went with my son, and we were trying to get him a credit card, and he doesn't have a job. And right there's like, well, you need 6 months to have he needs 6 months of having a job so they can actually get him a secured credit card, by the way.
Right.
So I'm like, and of course, me and him, he's only 18, but thank God that I know about this. So yes, and I can see how we can pass on that generation stuff as we have been talking. Thank you.
Right. Manny, thank you for your shared experience. Appreciate that, brother. Melissa, you had a question? Go ahead.
Well, it's kind of just a comment. As I was preparing for today's show, sure. I did listen to the poo-poo from what's his name?
Dave. We're just gonna call him Dave.
Ramsey. Yeah, Dave Ramsey. And I came across a good channel that has a rebuttal to everything that he said. This guy kind of outlined it. I'll have to dig it up and post it later. Okay. But anyway, they were and then I went on to some other videos, and I just want I want his take on this, Legacy's take on this. So what they said was, because Manny had mentioned about the policies growing and growing and growing, getting 100,000, 200,000, 300,000, whatever. What these gentlemen were saying was that as you do get have greater and greater amounts, of course, and if you start taking loans out, and that those policies can get expensive, right? But they were saying as some form of protection, if you intended on having a policy that was super huge like that, it might be a good idea to have more than one policy, just as a form of protection, so that if something, shit hits the fan and you can't make this huge payment, right? But you can make smaller ones, and you can manipulate those a little bit easier than having one great mammoth policy, which again, I'm an outsider looking in, just dipping a toe into this, but that did make sense to me. Just even if you do want to be able to pay yourself back, from what I understand, and you want to be able to pay that minimum premium for the insurance, which I know we're not doing it for the insurance, and we haven't really talked about that much, but that is kind of a big win also, in my view, that if you were to die tomorrow and you had one of these policies and you were paid up, your loved one is going to get that money. And I mean, that's pretty fantastic. So not only are you recycling basically your own money, you're making compounded interest off of your money, and you're able to borrow against it and all that. And if you pass away, there's that insurance policy that's paid out.
And
Yes,
not to
you
mention,
know,
you can take it out after a certain amount, like say 20 years. There's somebody like me. I don't have anybody. I have no children. So if it's just me, I can take out to live on 28,000 against this policy that was accumulated, and
Right.
they'll just take it out of the
death benefit.
death benefit, because I'm not
Yep.
doing it for the death benefit, and then whatever's left over will go to Brent or
Heritage hogs.
my dog or whatever. Exactly.
Yes,
Heritage
and-
Hogs, shameless plug. Thank you.
Can you expand on that? So are you saying
Sure.
at some point where when you get to a certain age, maybe you're not able to afford it? Are you saying your death benefit will actually start paying it, or how does
That
No,
cash
no.
policy is your money. And so after 8 years of paying the premiums and some other stuff, you can let it grow. And then say you're 70 years old and you don't want to do, you've bought
Sure.
everything. You bought your Lambo, you bought your house, you paid for this, all you want to do is just buy a little bit of groceries, live a happy life, take $28,000 a year. You just take the 28. That's it. You don't pay any more premiums. You don't pay any more loans back. And then whatever they'll just net it out at the end of when your time has come, when your number's called, and then they'll just figure it out, the math, and that's it. So you can live on that later.
I see? So as long as you have enough principal paid in, enough of a bag, right, to be able to borrow against,
Yeah.
and you've already fulfilled the obligation for the policy itself, or you take out enough that is still going to pay for that policy every year to still be in
Yeah.
effect. When you pass
Exactly.
away, any unpaid
Exactly.
loans, pay those loans, and then the balance is going to go to whoever your beneficiary is.
Yes.
That's right.
Yes. And can I
Absolutely.
make a couple?
Yeah,
I'm
let
sorry,
Jarrett clean
Go ahead,
that
Jay.
up for me. Yeah, because I'm not sure if it's accurate.
One thing that Melissa said, I just wanted to be clear, is term. When we think about term, that is the kicker. That is what can create. It will increase over time. The older you get, the more term's going to cost. So that's what we want to look out for. It's just temporary. You're just renting insurance. Now, I can see where it's a benefit to us sometimes, where we will throw some term on so we can crank up the death benefit, so we can throw large amounts of cash in it to where the IRS can't say anything that, oh, well, your death benefit's here. This is how much money you're throwing in. Okay, so it's insurance. So they are tricky ways to use it, but this here gets cheaper over time. It's expensive to start with because it has to get going. But after that, it gets cheaper and cheaper as you move along, as long as you don't have any term or anything. And I wanted to clarify, you can stop this at any time. You can do what they call a reduced paid up, where you pay, hey, I don't want to do it no more. I'm stopping right here, and they'll do a reduced paid up. But whole life, you keep it for life. That's what Manny was sort of hitting on. These contracts don't go away. This is permanent whole life insurance. So as long as you keep your end in the contract, now that's what we're doing. When we're talking about infinite banking in the Nelson Nash way, we are pinning the insurance company to a contract, and we are abiding by that contract to the letter. That's really what we're doing. That's how we get the guarantees. That's how we know that they're going to do what they, and even if they went out of business, another insurance company would come in, they buy up all the policies. I think that may have happened in the past, but
it's happened
these companies,
extremely rarely.
yes.
They're counting on you failing. They rarely fail.
Yes, that's right. And that's the same way with term. They're counting on you either not wanting to pay it to continue it, or something or it gets too expensive. But like 1 or 2, like 1 or 2% of term policies ever pay out. So why would you want to use a term unless you're using it for a specific reason?
Right.
But anyway, I just wanted to hit on that. I don't know if I help Melissa out any or
I-
not
Well,
on what we
No, yes, you did. That does help me. It does help. You know, one thing that makes that comes to mind here is that the people, those of us that are in the digital asset space and we've been doing our homework, this is kind of a parallel to that in the fact that you do have to do your homework and you do have to understand what you're getting into and you do have to be disciplined, right? And when you're talking about, you know, Simon often talks about contracts and words matter and all these types of things. This is just another example of, you know, this is not probably for the undisciplined or weak, well, what do I want to say? Like undisciplined, weak-minded, non-research type person. This is for somebody who really wants to understand the concept. And if you're already dipping your toe into what is money, what is this digital asset space, this sounds like a very good thing to have a third, because everything comes in threes, right? This is the third concept to maybe give some attention to, that it sounds like we could really all benefit from. So that's more of a
Yes,
comment.
and can I hit on one other thing, Melissa? You mentioned earlier about multiple policies and if things get tight. Once you start really doing this where you have multiple policies, you can take a little bit of cash if you have to. We don't recommend it. We recommend taking the loans, but you can take a loan to pay premiums on these. There's a lot of little switching and stuff that you can do to cover a premium. And can I answer Brad's question that he popped up about
yeah. We can go to that
or the
in just
time?
1 second,
Okay.
JV. Just 1 second. See what Melissa and folks out there, the situation, times get tough. We all know that, right? But you have this obligation that you have to meet, right? You got to keep your end of the deal with the contract with this process, right? That's a little scary. But what JV is bringing to the light is you could borrow against the cash value to make your yearly payment and then you're done with it, right? And then you could pay that over time. And I'm using this loosely. Okay, it's whatever you agree to do because you're the owner of this contract. The insurance company is the hired help to manage the funds to a pristine number. That's their
right.
job. That's what they get paid to do. But you are the owner. So, to something else that we're going to jump into after Brad's question here is the crypto professor has a question that relates to some of this where we're kind of jumping into utilizing the policy to pay for your life once a year, every year, something along those lines, or the velocity of money. But let's get to Brad's question here just real quick. Brad Grove, question. If you had cancer or an autoimmune disease, can you still get a whole life insurance plan? JV?
Yes, sir. You may not be able to, or it may be a little expensive. And some companies, anyone that you have an insurable interest in, your husband, your spouse, a business partner, your kids, your grandkids. So even if they don't approve you or you don't like the terms that they come up with, just pick someone that you have an insurable interest in. And basically, you'll own the policy. It's on their life. You get to use it for the banking and all that. And you can pass it off to them when you're done with it. I hope that helps. But business partners, and a lot of people don't know this. If you go digging into this, banks own a lot of BOLI, bank-owned life insurance. And there's COLI, corporate-owned life insurance. Walmart was buying policies on everybody back in the day without their employees knowing about it. Well, now they have to let them know that they're doing that. But
They were buying insurance on employees?
Yes.
Yes. Banks will raise someone up to a VP level, or you're vice president of this operation, or you're vice president of that operation, and part of your package is X, Y, and Z. But basically, they'll buy a whole life insurance policy on them. They'll give them a little money if they ever leave, but then they get paid millions. They'll fund it. They'll get paid millions in the end when that person graduates. That's the way I like it.
All right. Manny, you had another comment on that?
Yeah, Jim Harbaugh got his policy through the Michigan, how he does the football thing.
Yeah.
Jim Harbaugh, the football player. Anyway, he had one of those, so he's one of the highest paid people. So when he graduates, he's going to get that, or his people. That's why they say that he's the highest paid in
Right.
college football. That's it.
Right. Because of his policy, right? Not so much
Mhm.
cash, right? Avoiding Uncle Sugar with vengeance. I love it. What a plan. What a plan. Any comments there for Melissa on what was just explained with by JV? You get that?
I do.
Good.
I do. That
Good.
was good. I appreciate
Good,
that.
good. Let's jump into here's something. Utilizing the policy for maybe let's paying down some debt. I know at least two people in here that are very hyped on the strategy or a strategy to do this. Here's the crypto professor. What's up, brother? Showing you some love. Thanks for stopping by today. If I have a mortgage already, is there a strategy to use to pay this or to pay off that mortgage? Elizabeth, is there a strategy to pay off that mortgage?
My mortgage as an example, it's not a classic, it's not a traditional mortgage. I have my brother-in-law has the deed of trust and a promissory note. And how it's going to be structured in a couple of different ways is he is made it so I'll take chunks of the policy. So as I go each year, the policy will grow in the cash value to death benefit ratio, right? So I'll get the cash value each year is more and more and more, and we'll give my brother-in-law that chunk and ask him to reduce our payments, which is an ancillary thing. It may or may not happen. So I give him a chunk, and the next year I give him another chunk and another chunk and another chunk. And in 5 years, we have a very humble place here. So in 5 years, that should be satisfied for us. So you can do that, and you can look at other options. I bet you Jarrett has some excellent ideas, but for me, that works great because I don't have a $400,000 mortgage, but I have other stuff. I have a student loan, which is nutty, and I have others, tractors and SBA
911
loans.
Porsche in the back 40 that you don't know about.
During COVID, we got this email going, SBA loans, and Alan's like, oh, everybody's getting these SBA loans. So I like, sure, I'll get an SBA loan and you don't have to pay it back and all this stuff. And I applied. They didn't screen. They didn't do. You just sent the email and they said, congratulations. Here is, and I said $30,000, which I thought was a lot. And then I could have hit 100,000, and thank God I didn't, because I'll tell you something interesting also, which people miss from this. And that's the interest on, speaking of mortgages, is the interest that you pay on your mortgage is not the so-called great 3%, 4% deal that you got. You are paying 95% or 85% or whatever for years, for decades to the
Don't
bank.
get me fired up now.
Okay, but you, and then what they do is they convince you that, but we're going to give you a new interest rate, even better.
Start over.
I know, right?
Start over paying them 80% interest. And that is a really nice racket for the bank. It keeps them going in business. But whatever you do not refinance your mortgage
Right.
before
Absolutely.
talking to somebody from whole life insurance policy. Just
And I,
make the payments. The interest rate is not important. It's the amount of interest
the
that
volume of money you're
Volume of
spending on
interest.
the interest.
you
The
know
volume of
that
money you're spending.
that SBA loan that was supposedly not going to ever have to be paid back. They sent me a little letter saying, start paying us back. So I started paying them back, and I was like, I started doing what shouldn't be done because Simon didn't call me beforehand.
My apologies on that.
And so I started trying to pay it down, thousands, 1,000, 250. You know, I just started to like, I want this to go away, right? And I told Alan, I went, Alan, they're not reducing the principal on this at all. I've sent them like a lot of extra payments. And he's like, hello, that's the way it happens. That's how this works,
Yeah.
my friend.
So,
Yes.
so to the crypto professor's question though, you know, could you do this? Okay, you start a policy. Okay, you're still gonna make your payments to your mortgage and that for a time, but you're working this policy into your budget, right? So let's say you do get cash value side, you got 20 grand. He could then take a loan from that cash value side of the policy, right? And then he could pay down the my gosh, what am I? I'm brain farting now.
Principal?
The principal. He could pay down the principal on his house payment, right? And then he can go, excuse me, could you please recalculate? By the way, you can do that once a year on your house. You can call for a recalculation. They'll recalculate your principal and interest rate, and that thus will actually lower your payment. Now, he would have to keep the cycle going through, but say 2 years later, because maybe he was a good boy, maybe he worked it out to where, hey, I paid that balance down. That it lowered my monthly payment. Say it was $1,000, and now it's $700. That extra $300, he could go back to pay that $20,000 down that he borrowed. He could pay back his bank because he's a good boy. Then let's say 3 years later, whoop, 20,000 just got opened up, plus more liquidity because he's been paying 3 years into the policy, and now instead of 20,000, maybe he has 40,000 available to be borrowed against. And he's like, yeah, watch this mic drop. And he borrows the money, he throws it at the principal, and he goes, excuse me, recalculate, and whoo, it goes down to say maybe now his monthly payment is $300, and again, he can take that $700 of cash flow, apply it to the $40,000 loan that he did, and you see what I'm talking about, the cycle, the recycling of money, right? And not not spending that $700 on Starbucks.
No, you're
What is-
exactly right, and that's interesting because Vance told me to do the same thing.
Right.
Sorry, Melissa.
Well, I'm just saying,
Well,
what is this? I've never heard of this. Ask him to recalculate thing.
Okay,
Well,
so
Well, for the layman or the people like me that don't know what you're talking about, what
so
exactly?
you can once a year, and you have to meet an obligation. Typically, from what I understand, it's $1,000. But you can ask once a year to your mortgage lender to recalculate the payments based on the outstanding principal. Okay, so but you have to pay, I think, $1,000 extra above what your normal payments would have gone for that year. Example, let's say mine. Let's bring up mine. Let's talk about mine. I pay $127 to my principal. God, that's beautiful. I pay $1,800 in interest. Woohoo! Wow! So it is in my best interest to knock down that principal. Now, this is something that's talked about all the time. This ain't nothing new. Knock that down, knock that down, knock that down. But what they forget to tell you at the end, you have to ask for a recalculation in order to actually lower the payment. So this comes back into contract, right? They're going to say in there, we'll do it for you, but you got to ask us. And guess what? You don't know when to ask. And they ain't going to tell you. You're a grown-ass person. Ooh, earmuffs. Sorry, people. But you're a grown adult. You should know when it's time to ask. So the professor could do that. And go ahead, Melissa.
So if I'm understanding you correctly, Simon, you're saying that you take an extra amount to pay at least $1,000 more of your principal towards your principal. So you do have to increase your payment a little bit to pay at least 1,000. Then once a year, you ask them to recalculate your payment based on the amount of the existing that you owe, which then is going to lower your payment. And then you would then pay that same payment or in the additional. And every year you do that, your payment's going to keep going down lower and lower. And if you continue to pay, you're going to pay your principal off a lot faster because they're going to recalculate your payment every time.
Yes, but you don't want to add a little extra on your monthly payment. You need to meet your monthly minimum obligation, right? So your normal house payment, and then you got to come out of left field with the hook punch to the principal and go, there's an extra $1,000 separate from my normal payment. And then you could ask for a recalculation, and they'll say, we don't mind doing that, but we do those at the first of the year because blah, 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 or, whenever they might do it. So this, this kind of, how that is achieved is a number of different ways, but the way that you would do that for this discussion is you would have already okay, in 2 years time, I'm going to drop the principal down protocol. And I'm going to do that with this infinite banking concept, right? That's through a whole life insurance policy, the vehicle, the means, right? To go and do that. It gets really, really big into this, kind of this process here. And that is, the cash value side of the policy is the bank, okay? And one thing that banks are very known for doing is, 1, loans. They love loaning. 2, the number 2 thing that they love to do, oh man, you ever want to see 2 bankers fight? It'll be over buying other people's debt. Woo-hoo-hoo! They love that. So what is buying somebody else's debt? This would be like you, the debtor. You did a balance transfer, JP Morgan and Chase to Bank of Not So Free America. Bank of America. Okay. Well, Bank of America, in turn, what they did is they bought the debt. They sold you on a air quotes better deal, even though initially it looked better because it's $10 cheaper a month, and they offer you some bells and whistles that you'll never realize, right? So that bank bought the debt. So you could use the cash value side of that policy to do the same thing. Got a $10,000 credit card. You're like, cool. I've been 2 years running with this whole life insurance policy. Man, I got $5,000 that I could throw over there. Okay. My bank's going to buy $5,000 of that debt right now. Boom. It does. The debt goes over here. Okay. That in turn on credit cards, that should initially lower your monthly payment, right? So now you have, let's say your monthly payment on that was $100. And since you paid down half of it, now it's down to $60, which means you have $40 net that you're not paying anymore, right? $100, lower the payment, $60, $40. Cool. I know. Slow it down to 0.5 speed to catch that up on the replay, everybody. So now you have an extra $40, right? So you got a couple options here. That money better not be going to no extras, no Starbucks, maybe one date night for a celebration, victory. Okay. Other than that, you put that back into the policy because you're a good debtor. You gotta pay your bank back. You love your bank. You take that $40 like it's nothing. Go over there, feed that demon, feed that demon, feed that demon. At the same time, you're still meeting your yearly obligations to that policy, and you're trying to max out. What do you do again? 2 years later, maybe it took you 2 years to get another $5,000 liquid. Whoop, you go right over there. Boom, you knock that out. It's gone. On Main Street, you're debt free from that credit card. On Private Street, you still owe, $6,000, but you're not paying the same interest rate because on the loan back here, on the whole life insurance policy loan, the collateralized loan, it's not quite like this, but I'm just going to say it. It's like simple interest. That insurance company is charging you 5%. It's typically a straight up 5%. At the same time, you knock down principal, that interest, that money that went to the 5% interest gets lower and lower and lower. Versus most things in our lives where it's front loaded with interest the whole time. Back to what Elizabeth talked about. Alan,
Yes.
why the heck is my principal not going down? Man, sorry, baby, but you're doing good. I love you. I'll cook you the sushi you want, or whatever, right? But that's what you're accomplishing here. Like that is the play. We are, as Nelson Nash talks about in the book, we literally finance our whole lives. We do. It's part of it. Unless we're on our game day one, it's part of the deal. So quit sending your volume of money across the street to Chase, Bank of America, Wells Fargo, whomever, Citibank. Look, banking's going to be here. We need banks. So I throw this out there. If you can't beat them, join them. That doesn't mean y'all got to go to the same holiday party together. No, you join their ranks. You're an equal playing field. And now you're the competition. The really cool part is they don't even know who the hell you are. All they see is their numbers are starting to go down and they don't know what the hell's going on. Suddenly in the mail, you're getting multiple offers for credit. Hey, come back. We'll do this. We'll do this. Hey, I'm good. They treat me good. Which bank are you with? It's a private thing. I'm sworn to secrecy. No, I can't do it. But thank you. You guys really helped me see the truth in the world that y'all some greedy mother beep beep. But that's something you could do.
Simon, I liked it.
Simon, may I?
Yeah, JB, come on with it. Somebody else jump on this knocking down the debt train with the whole life insurance policy.
People refinance their house on an average of every 5 to 7 years, or they move. And Simon, you made a great example of what the first few years of a mortgage will look like. Now, I'm sort of coming from the safety side. I'm all about no risk or very low risk. To me, if you start paying down your principal, that's from the bank's point of view, hey, look at all the equity we could get if we could take their house. I'm just saying it like that. I'm not saying that they're doing anything nefarious. I'm just saying from a risk point of view, if you knock down if you could do it at one time, boom, drop it on them, pay the house off, that would be better. I mean, most people can't do that, but I'm just saying, just when I'm thinking about it. But this velocity banking, using velocity banking with infinite banking. If you don't know what velocity banking is, it's basically what he's talking about, where you're dumping lump sums towards a debt that you're trying to get paid off. And you may think I'm crazy, but there is a way to take credit cards to pay off credit cards. Now, and that is not where I'm just running up a balance on it. I'm talking about taking credit cards to pay off a credit card and your balance is dropping. And a lot of people don't know that, but that's one thing I'm trying to specialize in now, because I can't, like I said, I never wanted to be an insurance agent. I want to change the world, and I want to help people get out of debt, stay out of debt, create a bank for their family for generations to come. That's the goal. That's
right. And that's why you're running for president of the United States in 2030.
Yeah. Well, when I found out that I had to be an agent to be an authorized infinite banking practitioner, then that's when I became an agent. So that's basically how that worked out. But if you go ahead, Mr. Manny.
Yeah, go ahead, Manny. Real quick, and then I want to jump in some of these questions. We're gonna have to do a 15-minute blow through them questions here. So go ahead, Manny.
I wanted to say, you mentioned velocity banking, but at the same time, I was going to say earlier that initially I had this thought, okay, I have a line of credit. I'm going to use that line of credit. I'm going to grab $6,000. I'm going to, now that I have my pallet policy, because I haven't done this yet, and I may do it, may not do it. But the point is, grab that $6,000, borrow it. Okay, I'm going to be paying interest on that. Yes, of course. But at the same time, I'm going to throw it into my policy, which the one I have, I can put 10 grand in for the year. So I don't know if it's calendar year, whatever. But I was going to do that to put it over here, and then they can start growing interest. So even though I'm paying interest over here, I'm still making interest. You know, I'm getting paid interest. So at the same time, you know, I can fund my policy, can start making more money, and then the loan that I got from the line of credit, I can just pay it down, pay it down, pay it down. And I just let this grow. And same thing with the mortgage. You know, like you can use the line of credit for that also. You know, you go and throw the money in there and do what you did, or what you said, Simon. You throw the money in there, but at the same time, you still got this bill over here. So you know,
Yeah,
you got to think about. There's a lot of things you have to think about.
Yeah. This is where the disciplined mind comes in. You know, especially, I preach to the high heavens. Everybody in here mostly knows, and even I know NFT Solutions is still out there. You know, it is this richest man in Babylon, a rich dad, poor dad. Pay yourself first. Learn how to take 10% of your earnings off the top before you do anything else with your money. You take 10%, you set it aside, and you say, this is for building my estate and the estate of my family and the generations to come after me. Okay. And that takes time itself, because now you're doing this. You're doing this journey. You're learning about yourself. But I'll tell you what, if you can get that into play, and I really mean get it into play. Like, I forced myself to go to the bank every payday, even though I didn't need to. I got a debit card, get what I want. I do what I want when I want. But I forced myself to go to the bank to pull out that money, right? And I made it religious. And then there was one day traffic sucked. I missed the exit. I'm on the phone with my wife, and I'm like, I said some cuss words, man. I'm not happy. She's like, what? I'm like, I missed my turn. She goes, honey, that happens to you all the time on the phone. I'm like, no, man, I missed a bank turn, man. I'm not going to be home for 2 hours. Forget dinner, just whatever. I was so mad because I was going to be late. I'm like, I'm not going to get to the bank. I'm trying to get this money. It's my money. I need to put it in my pile. Fast forward, I had to use it. Life came along. I had to use it. I was not happy. I looked for any other way that I could utilize anything else in my life that I could sell, flip, this or that. Nothing was working out. So what did I do? I created a loan, because from the richest man of Babylon, there's the 5 rules of gold. First one is, save 1/10 of your earnings, no less. The second one is to find your gold, gainful employment. So I did that. I told that pile of gold that I had, said, congratulations, you now have a debt. Simon Says Crypto is going to be paying you back 10% simple interest over 12 months with another 12-month extension with another 5% on top of that, if that happens. And on paper, I still have the loan, started paying it back, started doing some things, had to borrow the money again, created another loan. As it turns out, I owe about $2,400 to Simon Says Crypto First International Bank. But the point is, that wouldn't have been possible if I first off didn't do the 10% pay yourself first. It's the discipline. Secondly, I thought it was cool that I found, hey, I'll just create a loan and I'll pay it back. Turns out this guy Nelson Nash beat me to the punch on that, on that method with many others. But hey, is NFT Solutions still in the house, man? I really wanted to bring him on to share. I know we got a few questions here. Thank you, Elizabeth, to answering most of those. It looks like Cody is pretty good on the questions.
I'm not sure. I think Cody could have, maybe Jarrett could kind of come behind, clean up what I told him.
Okay, let me see here.
Yeah.
Let's start at the top. Okay, here we go. Jarrett, we're shooting from the hip, or JV, we're shooting from the hip. What's the minimum amount to deposit into the policy?
If you want to use it as a bank, I recommend, and most of the practitioners that I talk to, we pretty much say 10 times your age per month. Now, if
Okay,
you're
so if you're
over
35,
55,
yeah,
yeah, about 350 a month. Now you
perfect.
can pay less than that. Yeah, there's no, I mean, I'm sure that there is a minimum, but when you're trying to use it for banking, we recommend, about 10 times your age. So if you're, 20 years old, versus now if you start getting too close to 55 or too close to 60, you may want to do 15 times your age, because the price of insurance is
Right.
costs more at that age. But
Okay, cool.
but one of the examples I wanted to say, what is that? Well, after crypto and money, I'll let you do
This is
the
a
question.
continued
Fine.
conversation. We're
Uh,
gonna knocking them out. We're firing from the hip.
I hope that I answered that, but I wanted to say something that someone was talking about, paying debt, especially mortgages and that
Yeah,
type
crypto
thing.
professor.
If you want to, you can send extra payments to these, but if you're not careful, you'll spend all your money. Let's say, hey, I'm trying to pay off a mortgage. Let's take every penny that I got left over out of my paycheck and pay it towards the principal of this mortgage. Well, there's no safety net in that. If something comes up and you've already sent them the money, they're not going to send you any of that money back. So they're, by using these policies and flowing things through a policy and doing these lump sums, and maybe don't take it all. There's a way to do it to where there's always some kind of safety. To me, it doesn't matter if you pay off a credit card or pay down a credit card. There's you at least something to replace a tire, and
Yeah.
a little emergency.
Right. Right.
I don't want to have to pay interest on it, but you know what I mean. There's ways to do it to create these little safeties. The Dave Ramsey folks that want you to save up 6 months, well, that's fine, but that can take somebody 2 years to save up 6 months worth of salary, for their emergency. If everybody did that, it'd be 2 or 3 years. Think of all the interest that's going out the door to these, snakes and dragons. That's what Nelson called them. That you never get back if you. It's time. If we waste time,
Right.
we're losing.
We're losing it. We're missing out on the opportunity. Every dollar we spend today is 10,000 we lose tomorrow, but those are my words. I got no math on that.
I just want to talk about that from a safety standpoint.
Yeah. Don't go all in. Again, that comes to the disciplined mind, sitting down, doing a budget. I know I said the B word. Ain't nobody like that, but real deal, become a master of your money, become a master of your budget. I know everybody picks on a Starbucks, but you could stop doing other things first if you're really infatuated with your Starbucks. Just saying. Let's see here. Where did do you have to fully fund the policy to be able to withdraw? Okay, here we go. Do you have to fully fund the policy to be able to withdraw, or can you withdraw whatever your principal is? Cody, are you talking about like the exit strategy, as in you want to end the policy, you don't want to do anymore? Can you then withdraw those funds? Is that what you're asking? Also, I meant withdraw in terms of a loan against the policy, not oh, there it is. What do you know? Just read a little further, Simon.
Within the first 30 days, usually about 2 weeks, once they see the money is clear, they have a bunch of anti-money laundering laws and stuff. So they,
right.
If you want it quicker, if you'll send them a printout of your checking account to where they can tell that, there's nothing really strange going on, then they'll send it to you quicker usually, but about 2 weeks.
Okay, cool. One more question, and this is the UL, and I know Nelson Nass talks about it. If you could do a semi-quick answer on this, because I want to hear just NFT Solutions. I want to hear his beautiful voice and tell us like it is in his experience. Or is he gone?
I'm sorry, he's gone.
Oh God, man, I love that dude, man. I was trying to give him some time. Okay, anyways, here let's plan NFT Solutions, man. I love you. We're gonna bring you back because this ain't the last time we're gonna talk about the infinite banking concept and all details, and I've gone all over the board. But here it is, Cody Garcia.
Shout out to Nicole and I Am What I Am on Spaces.
Thanks so much for listening to us.
For stopping by the show. We appreciate
the
you.
X Factor.
We
Aside from XRP X Factor, is Universal Life a viable option for what can be achieved with the whole life policy, or does whole life just blow UL out of the water? Your thoughts, JV?
There's Index Universal Life and there's Universal Life, and we do not use either of those. We don't use Index because it's tied to the stock market, and the whole idea of this is guarantees. Universal Life, if we're not careful, the way they do the term, it can get more expensive, and if you're not careful, it can eat up your cash at the very end when you need it. So we don't mess with those. One thing, Universal Life, you can like change your premium, you can do all these things. Well, we want them tied down to a contract, and when they do that, Universal Life, if you look at the contract carefully, it can be changed. Certain parts can be changed over time from by the insurance company. Whether it's the term, how much you're paying for term, if you have term. So we don't do that. We're really pinning these guys down to a contract that can't be changed, and as long as we pay our premium, they can't renege at the end. We're guaranteed to get paid. Our family is.
Gotcha. Let's see. There's go ahead, Melissa.
All right. I noticed I'm looking in Spaces and I noticed.
Yeah, there's a few more. Yeah, throw them out there. Go ahead.
They had a question that said, I'm retired, old. We're all old. I am what I am. No debt. And I'm looking for a way to maintain the fiat we've accumulated. I do not foresee needing to borrow. Is this something that can work for me?
I would look more for like an annuity. They are, these whole life companies, these mutual companies, they do annuities. Now, if you make profit, you still paying Uncle Sugar. But
right.
Those are pretty good as far as like if you had a large amount of money at the end, if you didn't have family or something where you could, give your granddaughter or someone a head start, because when I love the idea of a child because they never have to suffer the way we did. If this is done right, they can retire at 40. They have money for their houses, money for their cars, and they get to pass that on. But if you don't have anybody like that, and see when you do that, you can, like, if you can get some type of death benefit for yourself and get a policy on them for the banking part of it, then when you graduate, your funds replenish the money that you had to use out of it to live off of. So it just all depends. There's a lot of different ways you can. There's a lot of different ways you could do that.
I would say get a little XRP, wait for the DeFi things to take off, and then there you're good. you're real good. It'll maintain for a little while, but that's just me. You could do the same thing with Bitcoin, but I'm opinionated. And you can transfer that to anybody at any time for any reason. No permissions at all. Let's see. Was there any more in here? I know JRB in the house asking some good questions, man, but that is slightly on, I think, the Beyond the Brink topic, man. We should probably talk about that on the Beyond the Brink JRB's.
Well, unfortunately, there's only like,
Oh, we only got we're out of time. See, I told you. I told you I can milk this cow. Well, any final thoughts from our panel or you, Melissa? Any final thoughts? Or the crowd? Anybody else listening out there? I know a lot of people are listening out there. We did bounce around, but this is a big thing to unpack. But go ahead, final thoughts, everybody.
let's
Melissa?
do round robin, Manny.
Okay.
I think the biggest thing that's been mentioned many times is basically your education on yourself. That's the main thing, whatever it is you got to study it, and do the best you can. It takes me a long time to do things, but I do them eventually. So that's my thing, education.
Perfect. Thank you, Manny. Appreciate you stopping by today. Elizabeth?
Thanks, you guys. I love this topic. It's my new favorite topic. And just for anyone out there that's listening, since I started diving into this, and I have dove into this, it was Spanish. It's still Spanish, trust me. But I have taken some time away from that. I still do it every day, but this has become, I don't know, could we call it obsessive? Sure. I have that nature, but it also, between the Spanish and this, all that other stuff that's out there, every channel promoting, and you hear it from my husband. He tells you all day, every one of his shows says, stop worrying about the sky falling every day and just be proactive and do something to empower yourself in whatever way it is. Stop thinking that this is bad and that's bad and we're all doomed and blah, blah, blah. And just get on with it and live your life and get out of debt and stop trying to buy a Lambo and just be
What's wrong with the Lambo?
And secure. Well, okay,
Right.
get the Lambo.
No, I got it. No, we don't got time for that debate.
Remember Parkinson's law and the other.
That's right. Yep.
I've arrived. And be comfortable and safe and the money you have, because what you learn from Nelson and now me, Vance talks about it over and over. It's like you always end up spending the money, the more that you make. Like when Alan and I moved here, man, did we live small. We were able to live off of a very little amount. And then all of a sudden we made more and it all went away. And one day I had a windfall year and I looked and I got my 1099 and I was like, I made that much money. Where the heck is it? Right. No money management, no nothing. Right. Spent all my time watching Alex and everybody else tell me that I'm doomed and I'm got to live in a bunker somewhere. And it's like, just stop, put your focus on this, do what Simon says, read the book 3-4 times, listen to the podcast, talk to Jarrett, Manny's all into it, and just get into something that you love and be passionate about. And don't worry about the aliens and all the nonsense. And don't take experimental pharmaceuticals, but I'm just saying.
Thanks, Elizabeth. All right, JB, final thoughts. And go ahead and throw out your contact info out there as well, in case people want to have a 4-hour chat with you while they're sipping coffee on a Sunday.
Well, I love that, Miss Elizabeth. The noise, Nelson, you called it noise. And when I got into this, it's all I could do. I'd stay up late at night. This is all I study. And it sounds crazy because you would think that, well, we already know that's part of that arrival syndrome. Well, if you think you already know everything, then there's something wrong. That means you're not learning. You're not advancing. You think you already know all there is to know. So, what do you have to live for if that's the case? Right. But I love this subject. I love talking about it. Anybody that wants to contact me and just talk about it, throw some ideas around, I love it. I plan to change the world using this until I'm gone. Now I have some side jobs that I do, some other things that I have to do to finance my world, but this is the priority for me. This is all I'm focused on. So
Perfect.
my website's legacyvision.life. You can reach me at life@legacyvision.life. My number is on the website. You can't text that number, but if we create a relationship, then you can just text me like questions off. I mean, it doesn't matter. I love talking about it. So we can, I'm not trying to sell anything. I would recommend that if you're interested in this, go to someone that's on the infinitebanking.org website.
Which is
Those guys, especially their new program, they won't let you. I mean, there's some older folks that got in, and they got in just so they could sell policies. Well,
right here.
they are very strict. Yeah, they are very strict now about the way you set up these policies. And for a long time, I've seen all this stuff about the 10, 90, 90, 10, 40% the base, 60% the PUA. Well, the base is what's driving this policy. If you wanted to spend $9,000, you got a $10,000 a year policy, and you put 9,000 in the cash side and 1,000 to the base. Remember that 9,000 is going to fall off one time, and then later on, when you're putting in $1,000, it's going to double to $2,000. Every time you put in 1,000, it's going to double to 2,000. You want to just be putting in 1,000 after you paid all the costs for insurance, and you've let it mature, and it's and it's kicking off. It's the only legal way to print money. I'll tell you that right
Unless
now.
you're a congressman.
It's the only legal way to print money.
Copy that. Here's the Nelson Nash Institute. You're welcome, man. I appreciate everybody. I really do. I want to continue this conversation on another night to be determined, because I think we need to do that. But here is the Nelson Nash Institute. And if you are interested in learning more, you can come here to the Nelson Nash Institute.org, I believe it is. And you can pick out your state and where you live, and it'll list a few practitioners in your area. And our folks to the north of us in Canada, you too can come here and select your area. We could pick Florida. Let's see who's in Florida. Nobody. Oh, here they all are. And you can just see where you're at in the old Florida, and you can maybe edge your guy, right? And there's Mr. Ed right there. Thought he was a horse. And here's a little profile about him, and you can send him an email that way. Just wanted to share that with you guys. That's a great actual resource right there. So with that being 6 minutes over.
6 minutes over, guys. Well, I just want to thank everybody for coming to the show. I love the guests that came. You guys shared your experiences with us and answered our questions. I look forward to hopefully having another follow-up show on this because we definitely just dipped a toe in here.
Yes, we did just dip a toe.
Definitely sparked my interest even more so. And I sure do appreciate your time, Mr. Legacy Vision Life. And with
thank you very much for having me.
Yeah, we loved it so much. We appreciate you. And I guess, Simon, what do you say?
I say we've dipped the toe, and it's time to go.
Take care, guys. Take care.
Thanks, Manny. Thanks, Elizabeth. If all the panel will just kind of stick around after the outro, we can do just a quick chat. Cool. These are the deuces, and we are cabooses.